Welcome to the B.F. Anderson Technical Report for April 21st. Be fearful when others are greedy, and greedy when others are fearful. Last week, the AAII survey, which, by the way, this is a very credible survey, been around for a long time. They've got about 2 million members. It was the lowest bullish readings in 30 years. So basically what this means is approximately 85% of those surveyed were negative. So pessimism is rampant. Now here's a graph illustration where I show the sentiment is the lowest reading in 30 years, and you can see where we are right now. We're down to a negative 32.6. We haven't seen this much pessimism in a long time. Now this is a double-edged sword, meaning that there's a lot of positives here because, number one, that means a lot of cash is on the sidelines that could come back into the market. But the negatives are, in the short run, there's just aren't any buyers. So that if you get into a situation where sellers come into your stock and there's no buyers, well, we all know auction market, the price is going to decline. But the other thing to realize here too is that the money's going to go somewhere. And you want to be really looking at opportunities where the buyers are coming in. So that would be the way to use this, is to say, okay, this is, everybody's negative. There's a lot of cash on the sidelines. But then if you see the buyers coming into your stock, that'll be a good sign. Now, the other point I want to make, what's going on with the market is don't fight the Fed. The interest rates are going up. What the Fed is basically saying is that the economy's too hot, they need to slow it down, so the opposite of growth. Now, just to kind of see what's going on in the bond market because of what's happening with the economy, inflation, and the Fed, this is the price of the 20-year Treasury bond ETF. You can see it's just in a very severe downtrend. It's gone from a high of around 153 and got down to a low of around 120. So the bond market is really taking it on the chin, and at the same time, if you look at the yield on the 10-year Treasury note, you can see what's going on here. Interest rates are really in a very powerful uptrend. Don't fight the Fed is basically the message. Now, as we can see here with the Nasdaq continues to have a difficult time here. We came down, made a low back in January. We got basically a rally, which is a counter trend rally within a downtrend. Then the rally failed, and then we made another low in February, consolidated, rallied again, but we've come back, and the good news here is we're actually making a higher low, so that's good. However, on a weekly basis, if we look at the 35-week moving average, which continues to turn down, now what we want to see is where the Nasdaq can get back above that 35-week moving average for 2 consecutive weeks, just not happening yet. Mid-cap stocks looking a little better. Again, we're seeing the bottom, now a higher bottom, and somewhat of a rally, but still struggling with the resistance at that 200-day moving average. Here's the New York Composite. It's actually looking one of the best. You got your low here, you got your second low, higher low, and breaking out above the 200-day. So maybe things are going to start to firm up here. The small caps, kind of the same thing, but mainly moving just sideways, still below that 200-day moving average. S&P 500, again, the same basic pattern. We made a low, higher low. Now, the question we have to ask here is that we know this is a downtrend. We know that this is a bottoming process, but is this going to be a rally within a downtrend and then, break down again? We'll just have to see. Now, on the S&P, the weekly graph looks a lot better. The 35-week moving average is basically moving sideways. Like to get that back above. So in other words, on the trend lines, which is what we call this, we need to have 2 consecutive weeks for both the Nasdaq and the S&P to issue a buy signal. Now, this is really a difficult graph here. This is the aggression index. In other words, when the index is moving up, it means that the Nasdaq stocks are outperforming the consumer staples. In other words, Microsoft is doing better than Procter & Gamble. Well, that's all changed now. Now, this all basically started to peak out back here in February of 21. We broke down, gave a sell signal, and really hasn't looked up since. In fact, the indicator actually made a new low yesterday. So we need to see an improvement in the aggression index. Now, the three economic indicators, we talked about interest rates, strong uptrend. Oil prices continue to kind of, just kind of meander, moving sideways. Financial stocks are seeing a little bit of improvement, but, the market is a little bit concerned about recession. Therefore, the banks would have a difficult time in that environment. New lows still too high. New lows on the other day got it up to 285. We want to see that start to get down, like back here, get down around that 40 new lows a day thing. And this is just kind of one way to determine when the sellers have finally run out of steam. Now, on the trend strength on the Nasdaq, we continue to be at 0. You can see here we made that big low, rallied up into the moving averages, pulled back. So trend strength is still 0, not very good. Now here is the S&P 500 trend strength. Continues to stay around the 40% area. We're above approximately 3 of the moving averages. We'd really like to see this get back above here and get back to 100%. Now on the volatility index, we're seeing a little bit of improvement there. The lower the number, the better. We got way up here during the bottoming process. We've pulled back to around 20. We really want to see the VIX stay below 20. Now, on the percent of stocks, now this is really important here. The percent of stocks for the Nasdaq that are below the 200-day moving average is now around 80%, which means 80% of the Nasdaq stocks are below their 200-day moving average. That's not a good number. Now, on this indicator, we are seeing something interesting here. This is a ratio that I've gone back and looked at historically. The ratio is the S&P 500 compared to the 30-year Treasury note. So in other words, when the line is going up, it means stocks are doing better than bonds. Usually this line and the actual index tend to move together. So this particular indicator has hit an all-time new high where the S&P has not. So that could be a positive indication. Now on the top 5, we're continuing to see a lot of commodity-related names. This is a company called Alpha Metallurgical. They're in the coal business. Maybe there's some clean coal technology that we need to learn about. I haven't seen it yet. CF Industries kind of breaking down below that 10-day. This is fertilizer. See, the stock's been moving somewhat sideways. However, it did kind of break down here recently. This is Lantheus, which is a medical supply company. Actually broke out. Now, they're involved in digital imaging for hospitals. And you can see here, big gap up, uptrend. The stock really does look very good. Marathon Oil, again, the oil stocks continue to kind of power things a little bit here. Marathon is in an uptrend, broke to a new high yesterday. Then last but not least, we're going to look at Occidental Petroleum. Again, these commodity names continue to dominate our list. Therefore, we should definitely pay attention to them. So all in all, everything is looking still like a bear market. Hopefully, bear markets tend to last about 12 to 16 months. We're now in the 14th month because we calculate that this bear market actually started in February of 21. So hopefully we're closer to the end of the bear market than the beginning. Thank you very much. If you have any questions, don't hesitate to call. Thank you.